There is so much money to be made in acquiring online businesses, e-com, aggregating, holdcos, SaaS, all of it. Hello, my name's Jaryd Krause. I'm the host of the Buying Online Businesses podcast, and today I'm speaking with Alex Prokofjev, and he has a 15-year career in investment banking and corporate developments, both as an advisor and a principal, originating and executing several hundred transactions spanning M&A, capital raising, and strategic partnerships. Now, Alex, he was the CFO of Three Colts, helped them build that out from 7 million to 60 million revenue per year. Now he's the co-founder of Roll Up Europe with his brother and doing some amazing things in the M&A space. Now, in this podcast episode, prepare to get fire hosed with an amazing amount of information around how to raise capital, build a holdco, what it looks like, acquiring multiple businesses throughout multiple years, and what that looks like. There's so much value in this. We also talk about Alex's journey and how he moved out of software itself, SaaS acquirers, and has moved into helping people build out holdcos, and what he's doing with his brother with Roll Up Europe. Now, there's so much value in this podcast episode. We do talk about acquiring businesses. If you haven't got my due diligence framework, make sure you do go away and get that at buyingonlinebusinesses.com/free resources. It's free, of course. It takes the guesswork out of buying a business. Let's dive in. Do you have a website you might want to sell either now or in the future? We have a hungry list of cashed up and trained up buyers that want to buy your content website. If you have a site making over $300 per month and want to sell it, head to buyingonlinebusinesses.co/sell your business, or email us at info@buyingonlinebusinesses.com, because we will likely have a buyer. Details are in the description. Alex, welcome to the Buying Online Businesses podcast. Thanks for coming on.
Thank you for inviting me, Jaryd.
So you mentioned that you kind of fell into this acquiring online businesses and tech assets, as in SaaS. I'd love for the audience to know a little bit more about how and why you fell into this sort of space, I guess the M&A space, and why you love it so much.
Yeah, sure. I have to take you back about 3 years ago. My background is investment banking. So I'd done about 14 years in investment banking, working in London. I'm originally from the small country of Latvia. After investment banking, I moved into corporate development. So I worked for a very big bank in Switzerland. And after that big bank, I went to work for a tech company as the head of corporate development. And whilst all three experiences ultimately helped me do what I want, I felt pretty unfulfilled in each one of them. And the reason being is when you're working with very large banks, it's extremely hierarchical. And in Europe in particular, it's getting really crowded. So it's very difficult to stand out if you're on the sell side. There's literally dozens of banks chasing very few mandates. Whereas in the tech company, I faced a slightly different challenge. A very successful business raised a ton of money, including from US VCs. But it's not a business that has grown historically inorganically, right? It's a business where the finance function, the corporate development function was very much viewed as a sort of a back office, if you want, right? And I just didn't feel like it was fulfilling enough for me. So I was facing this conundrum. And 3 years ago, I had a very fateful sit down, very fateful coffee with my brother. His name is Pavel. He had been in the roll-up space for a few years before that. And when I told him about my challenges, when I told him about what I was looking for, Pavel immediately jumped on it and said, listen, you got to join one of those software serial acquirers, because on the one hand, they buy tech businesses. So that's what you want to be. You know, it's very agile, it's very flexible, it's very inclusive. But on the other hand, you are doing lots of deals, and your M&A skills, Alex, are very central to the success of those businesses. So that was the start of it. Pavel then introduced me to a couple of CEOs who were looking for heads of M&A and CFOs for their businesses. And I joined a small e-commerce SaaS aggregator called Three Colts at the start of 2022.
Yeah, cool. So that's what I was going to ask you. Three Colts. So this isn't something you didn't go and acquire Three Colts. You joined them as a CFO, right? So what is Three Colts, and how did you come on board with those guys? I mean, you mentioned you did, but like, how did that come into fruition, I guess?
Yeah, sure. So Three Colts, in very simple terms, is an aggregator of e-commerce SaaS businesses with a focus on the Amazon ecosystem. So it's what I would call a platform play. Zendesk platform plays, Atlassian platform plays, Salesforce platform plays. So Three Colts' main mission is to acquire businesses that service e-commerce merchants on Amazon. Well, it was the mission 2 years ago. Now that he's moved on to become a much broader business in the sense that Three Colts seeks to assemble a suite of tools that enable merchants to sell on all kinds of marketplaces. So Yoda, the founder of the business, had raised the initial capital and had made the first couple of deals when I came on board, but it was very clear to him that he needed somebody to make the M&A machine more efficient so that it could end up handling 10, 15 deals a year. Another dimension I brought on board was the company had raised significant amount of debt. And it happens when you raise debt. There's a lot of covenants, there's a lot of reporting that you're expected to actually produce. And when you buy those small online businesses, one of the challenges that aggregators and roll-up founders hit pretty quickly is that the disclosure of those businesses is not good, right? So on the one hand, you're buying a business which has been bootstrapped, which is maybe doing a couple of million. It's all Stripe. It's some very basic kind of QuickBooks. Nobody does any accrual accounting. And everyone's okay because what matters at the end of the day is the cash flow, right? No cash flow, the business is dead. However, when you aggregate those businesses and you start raising institutional capital, your private debt or your bank debt, people start asking you for monthly reporting. People start asking you for covenant testing. People start asking you for audited financials. And if you're not able to bridge the difference between the two, well, either you lose your aggregator or you have to contend with much higher cost of debt because you are perceived to be as a risky borrower. So my responsibility at Three Colts mostly revolved around those two topics: businesses, finding businesses, buying businesses, and ultimately building up the finance function so we could see key KPIs in real time.
Yeah, awesome. And what do you mean when you said you lose your aggregator? What do you mean by that? You can't if you don't have this reporting.
So what tends to happen is that you need to give, so when you're raising debt, when you don't have a lot of track record, you typically have to give the lender a lien, or the collateral for the loan is essentially the entire business, whatever you've bought, right? Plus any sort of new intellectual property you've built at the HQ. So what tends to happen is if people default on their loans, whether it's an actual default where people are not able to make the payments or there's some sort of violation that they made, there is a short period which is called the cure period, in which you're allowed to make up for the omission or the mistake or the shortfall in payments. And if you're not able to cure within that payment, essentially the lender moves on to repossess the business, sell off the business, make itself whole on the loan, and you as the shareholder, you or your shareholders essentially take whatever's left of the business. And Amazon FBA mania, which is now past its peak, I think is a great example where aggregators bought a lot of e-commerce brands very, very quickly. But oftentimes the brands that they bought did not have recurrent revenues and were not able to demonstrate sort of uptick in revenue. And those aggregators failed to make payments on time and they ultimately lost it.
Yeah, pretty common actually, wasn't it, through COVID, the COVID era, I guess, where there was a lot of aggregators, Amazon FBA aggregators buying so many of those businesses, getting a bunch of debt and then getting smoked for I guess, multitude of those reasons, right? Is that what you saw?
It's hard to name a single reason.
You haven't been doing it since, I guess, 20. So you started with Three Colts, what, 2 years ago?
A bit more than 2 years ago, yeah.
Okay, yeah, cool. I want to learn a lot more about Three Colts. So you came in, you've gone in, and they must have had a bunch of already great running e-commerce brands, I guess, and maybe a few from Amazon, maybe a few from different sales distribution. And were they at a 7 mil valuation or revenue when you joined, and you have helped grow since then? What are some of the Yeah, I've got a lot of questions. How many businesses do they have when you first joined? How many businesses they have now? What are some of the things you've done along the way to get to the increase in revenue? And what is that increase in revenue since you joined?
Yeah, sure. So I think one very quick disclaimer, I don't work there anymore. So I'm a shareholder of Three Colts. I left the business last October to pursue my various entrepreneurial ventures. But I can obviously speak to the time that I was there. Obviously, as the CFO, I was very close to the numbers on a daily basis. So when I joined the business in early 2022, to his credit, the founder, the majority shareholder of the business, had raised the first batch of financing, debt, and equity. He had also executed on the first two deals, and he built up a pretty good pipeline. And when you consider that this was essentially the sort of work of a single person, albeit with some advisors, it's incredibly impressive, which is something that I think a lot of aggregator founders should pay attention to. Because there is this new tendency right now as capital becomes more available for holdco and sort of buy and build type of structures, people tend to bulk up on headcount early on. So it's not uncommon to see businesses that maybe have been operating for about a year or maybe 18 months, and they've raised 10, 20, 30 million equity, equivalent amount of debt. And all of a sudden you see an M&A team of 8 people, of 10 people. You see a lot of people at HQ. And I think that's wrong because ultimately you should always start with a very clear investment thesis. You should always start with a very clear pipeline. And I think, okay, sure, when you buy those businesses, and maybe there is a succession angle, you need to replace sort of CEOs or the GMs of those businesses, you should bring more people on board. But in order to develop a compelling investment thesis, in order to go and reach out to those business founders and ultimately execute those deals, you do not need a lot of people. This is absolutely core to understand. And that's exactly where Three Colts was at the start of 22 when I joined. Yoda had worked at Amazon, so he had a very clear thesis. He saw all of those third-party app developers getting access to Amazon's API. At the time when he started this, there were just over 2,000 businesses that had Amazon's API, effectively the addressable market of potential acquisition targets. When I left the business, I think that number had grown to almost 3,000 businesses. And so with the first two deals done with the financing, my objectives were twofold. On the one hand, the number of situations live, so somebody needed to come in and get those deals to closing, to complete due diligence, to complete the negotiation of binding agreements, and ultimately just to make sure that those deals are integrated. The second challenge that we had was the company as an acquirer constantly needed more financing. And so creating good quality investor materials and creating sort of a good quality pipeline of investors and just continuously having those conversations was very, very, very important. The other thing that a lot of aggregator founders maybe don't fully understand is it's not like one shot, one opportunity, right? So if you are in the market constantly acquiring businesses, you're probably going to need to raise financing every 6 months. Ideally that, so you don't actually dilute yourself. But very often, 99% of all equity and debt providers you speak to on day one will tell you, I'm not going to give you any money because either they don't believe the idea, because if they believed the idea, if they had heard about the idea, probably somebody else was doing that, or they just wanted to see a bit more track record. So the challenge for me as the CFO was I had a hit list of about 300 equity and debt providers. And I knew from day one that only a handful, maybe 5 or 6 out of the 300 would be genuinely excited about the idea. With the rest of them, it was this, okay, we got to work with these guys on a quarterly basis. We got to show them what we've bought. We got to show them the kind of platform value add. And I think setting up that cadence and having that kind of pipeline of investors was very important. Over the ensuing 18 months, we grew the business from about 7 million revenues when I joined to about 60. When I left last autumn, this was the outcome of, I think, about 16 or 17 acquisitions. The business has gone further now. I think the number of closed deals that Three Colts has is about 20. Yeah, and highly profitable business too.
Yeah, cool. Congrats. That's amazing. You definitely got to work and achieved an amazing result there. So you said you were roughly raising around every 6 months now and keeping that cadence going, showing proof to investors. How much typically were you raising and where were you finding the funds from? Was it, like you said, you did mention investors before, but were you going to any banks? Were you using any other lenders, different types of lenders? I should probably frame this by first asking what type of businesses you were acquiring through that phase as well, because that's going to help determine what collateral there is available for the lenders. Sorry, there's a lot of questions in there. First, start with what sort of like acquisitions you did make in that sort of time period.
Yeah, so very good questions, all very technical ones. So, I mean, I should say that the initial mandate, the initial thesis behind Three Colts was very much focused on SaaS. There are a lot of Shopify SaaS aggregators. As far as I'm concerned, in the Amazon space, when we started out, when I was at Three Colts, there were only two businesses. It was us and it was a Canadian, essentially copycat, which determined that the competition and the multiples we paid for the businesses were nowhere near what people were paying for Shopify businesses. And so essentially buying small SaaS businesses typically focused on SMBs and solopreneurs. Examples of businesses would be a lot of dropshipping tools. So tools to get you started as a dropshipper or arbitrage seller, tools to help you find attractive pairs, which marketplaces do you want to kind of arbitrage. The second category would be SaaS businesses that help you manage your inventory. So again, that's a pretty big challenge for a lot of Amazon sellers as well as Shopify sellers. What's the optimal level of inventory? When do you buy? Again, the reason why those tools exist is because Amazon's own tech stack and Amazon's in-house tools are pretty rudimentary, and Amazon has no incentives for whatever reason to basically improve that. But as a quid pro quo, Amazon has developed a pretty decent API for those developers to come and essentially fill the gaps. And it's not just Amazon that has this approach. If you look out and if you look at your compatriots Atlassian, they've done exactly the same thing. But obviously the scale is vastly different, right? If you think about the Atlassian SaaS marketplace, it's producing revenues of about $1.5 billion US right now on an annual basis across 6,000-7,000 apps. Of course, the kind of Amazon opportunity is a lot smaller. It was mostly SaaS businesses. In the process, we also looked at a whole bunch of productized services businesses. There are a lot of agencies out there that sell themselves. Everyone's trying to find the kind of like the philosophical stone where people have an agency, an SEO agency, and they get paid as a SaaS business as opposed to on a performance-based basis. I've not seen a single agency that would have been able to actually crack that, right? People come to agencies because they expect some ROI. And I think eliminating the ROI has been very, very difficult. We also got into profit recovery, which by now is a very significant part of Three Colts. So profit recovery for Amazon vendors and Amazon sellers. And ultimately, we also looked at Shopify, eBay, other ecosystems, but ultimately, we never really developed the conviction that those ecosystems were as easy to understand, as easy to operate for us from the acquisition point of view, right? But I think when you do buy those businesses, when you see, okay, where do organically I expand into, it's very natural that if you have a bunch of e-commerce sellers that are on Amazon, chances are they're also on other marketplaces like Shein, Spotify, eBay, and others.
Right. Thank you. And so with those types of acquisitions, what size acquisition were you doing roughly each time? Was it all similar or was it very varied? And then how were you acquiring that finance and from where?
So you won't be surprised to hear that any sort of buy-side interest heavily correlates with size. And so if you're looking to buy any online digital business, whether it's a YouTube channel or a SaaS or like a vertical market software business, the bigger the business, the more people want to look at it, right? Because everybody has to hit their quota. Everybody needs to build up the pipeline. And the kind of one lesson that I want to share is people vastly underestimate the amount of competition, the amount of buy-side interest for anything these days, right? Because information flow is very transparent. Everyone's using some sort of private company intelligence tool like SourceCrowd. Everyone's using email outreach. Getting hold of an initial pipeline and reaching out to that pipeline and proving out the kind of interest and finding out some financials has become very, very easy and very, very cheap. So for us, we typically had focused on the businesses between 1 and 10 million in revenues. I would even say probably the kind of lower bound for Three Colts now is a bit higher than that, because if you have a business that's doing less than $2 million in revenues, call it less than $500,000 in profits, if there is a succession situation, you need to bring in somebody to replace the founder, you want to have a very strong general manager, a very strong product manager. And I think there are a lot of people that come from big companies that find this very rewarding, but obviously if the business is very small and ultimately not very profitable, it's just not that interesting for them. Whereas if you look on the higher end, if you look at businesses that are doing more than $10 million in revenue, all of a sudden, all kinds of private equity backed players want to look at it. And so for me, the kind of sweet spot would be between 2 and 10 million. In terms of how you structure those deals, essentially you have two options. You can either buy the assets or you can buy the shares. The advantage of the share purchase agreement is that you essentially take over the entire business and all of its assets. In most jurisdictions, including US, Australia, UK, others, a share purchase is typically more tax advantageous for the business founders because they only need to pay the capital gains tax. However, the other option, which we heavily relied on, was the asset purchase agreement. So essentially you identify which assets you want to pull out and the company essentially remains an empty shell, and the founders typically would actually retain that. The advantage of that structure to you as a buyer is pretty obvious. You don't assume a lot of the risks. If there is some sort of a litigation against the business or if there is a tax problem, you do not inherit that. That remains with the founders. The disadvantage of that, of course, is that it's taxed double from the founder point of view. So the founder has to pay a lot more tax. And therefore, many founders are just instinctively not interested in an asset deal.
Absolutely. Yeah. And so it makes sense as Three Colts scales and grows, why wouldn't they just increase that bottom from 2 mil to eventually get up to 5 mil? I do understand keeping under that 10 million range where you have less eyeballs on those deals and they probably sell less fast because of that. So there's that, I guess there's that sweet spot, but as it evolves, it might even change to a different range and have different capabilities to more quickly acquire those types of assets versus having a bunch of small businesses within that structure that are not really helping this, allowing it to get that scale that it wants if it wants to continue to grow, right?
I don't think it's a question necessarily only for Three Colts. I think it's a question for most software aggregators, whether it's Three Colts or Sharp Circle or Stay Tuned or SureSwift or SaaS Group. I think the answer to that is twofold. I think one is a lot of those targets struggle to grow beyond 2 to 5 million revenue level, because it seems that there is a natural inflection point where if you grow a new business from 0 to call it 2 million ARR, typically you're too small for anybody to notice you or to copy that. Whereas if you're hitting a couple million ARR in any type of kind of vertical niche, you start being noticed, right? Either because you pop up in the marketplace, let's say you're in Wix marketplace or Shopify marketplace, people all of a sudden start seeing that you've got a lot of downloads, a lot of followers, a lot of reviews, And I know probably 3 or 4 basically SaaS clone factories based all over the world, which monitor and they try to copy that business. So that's pretty interesting, right? So, and I think beyond that level, there's just a natural inflection where all of a sudden, you thought it was just you, and then there's 5 other businesses, and then the market itself maybe is not growing a lot, so you're naturally capped. So the natural supply of those businesses in that sub 5 million revenue range is just very large because they never graduate onto the next bracket because it's very difficult. Also, a lot of the founders that I've spoken to, they view it as a lifestyle business. And if you look at the unit economics of those businesses, let's say if you're doing a 5 million ARR business, maybe you're running at a 60% profit margin. I mean, if you're in a tax advantage jurisdiction or you've got some other losses you can offset it, you're looking at 3 million after tax cash flow. Like, do you really need more than 3 million? If you don't live a fancy lifestyle, probably not. The other reason is, I think it's just about the deal flow, right? I think as long as people are able to find enough deal flow in that kind of smaller range and there's not a lot of competition and you can keep your multiples low, and most people will pay anywhere between 5 and 8 times EBITDA cash flow for those type of assets, why wouldn't you buy them? Everybody wants to buy bigger assets. Everybody wants to hit the 100 million ARR faster because there's this kind of perception that's when the multiple arbitrage will really switch on. But the truth is, if you want to bid on 10, 15, 20 million ARR businesses, you're facing off against mid-market private equity. And I can tell you they will be able to outbid you most of the time.
Yeah, it's a really good point. Even we find that the case for a lot of my audience where they're buying typically under the $1 million range. And then you got somebody that's in that range where you're at 1 to 10 mil, the bargaining power is just far better. So talking about money again, financing, do you have capabilities to raise financing through SBA, other lenders, or mostly just through investors?
Yeah, we've written extensively on our blog, my brother and I, about the different structures. I would say there's so many structures available. It's really entirely down to you as the founder to decide whatever sits for you. But I would say how Three Colts was structured and how a lot of other lenders was structured is how other aggregators were structured. We had financing essentially come in at the holdco level, both debt and equity, and then we would parcel it out down to new acquisitions. So for every new acquisition, we would set up an SPV, and then that SPV would be funded with shareholder equity and debt. So that's how it was done. So it was the acquisition was not raised on a deal by deal basis. Although, of course, every time we had to go and draw down the debt, we'd have to go to the lender and we'd tell the lender, hey, this is the deal. Here's some information. Please give us some money. What's really important if you follow that type of approach, because I can't think of a single aggregator where, let's say, if people have $100 million facility, the lender just writes a blank check. So what's very, very important is that you have your due diligence materials, you have your red flags reports, you have your investment memos very nicely written. That's the very first thing that I did. I said, listen, it's not just enough for us to do due diligence and people to get comfortable individually. All of those notes need to be aggregated in a crisp 10 to 15 page memo that we can pull out and show to the lenders. I think so. Kind of one idea is where you go out to your equity backers and first you need to raise some equity for a business. And I think I've seen people doing the SaaS aggregation game. First time they raise anywhere between 5 and 30 million in equity. And that, of course, depends on the strength of your bargaining power. So if you have a very compelling investment thesis, you're able to raise more at a higher valuation. If you don't have a very compelling thesis, you're able to raise less. And what I've seen, typically people raise, the least people have raised would be 2 million or maybe 10 million pre-money valuation. And the most I've seen for some hyped up ideas like Shopify app rollups a couple of years ago, people have raised something like 10 million on 20 or 25 million pre-money. We're talking about US dollars. Once you've got that equity in place, it becomes for you very easy to go and talk to the lenders. And the lenders will typically size their debt facility in relation to your pipeline, but also in relation to your equity. Again, the debt markets are always changing, but if you have a compelling thesis and you have strong investors, then you're able to raise in committed debt up to 2 times your equity. So if you raise 10 million equity, the lender will happily give you a 20 million debt facility, which you draw down on deals as you go along. There is a very interesting kind of dynamic here where on the one hand, you don't want to get a dominant shareholder. So you want to raise from multiple wealthy individuals, multiple family offices. So none of those have bargaining power when it comes down to equity, right? So everybody has some rights, but ultimately you as the founder, you want to be calling the shots, right? You don't want to depend on all these people to vet every single one of your deals. On the other hand, when you talk to the lenders, the dynamic is inverted because lenders want to see a brand name backing you. Lenders want to see a deep-pocketed investor that maybe has written 5 million check out of the 10 million raise. If something happens to you that they can pull out another 5 million or 10 million, the company will not go under. And so how I've seen people try to solve this conundrum is to go out to a bunch of very experienced, very wealthy ex-private equity people who write significant equity checks. So let's say if you can get 5 of those and they each write like a 2 million ticket, then you go to the lender, and those private equity individuals probably will have relationships with the lender, and you convince them, okay, it's not quite the private equity firm, but these people will not let the business fail.
Yeah, love that strategy. Thank you so much for sharing. And so, where have you gone now since Three Colts? You're working with your brother now, is that correct? And you're doing your own building out your own holdco, is that right?
Those two, and then a few things also in between. Yeah. So as I was working through Three Colts, I constantly had all these questions around how do different things work. How do you raise debt? How do you raise equity? Which investors are good? And what I realized is that on the one hand, there were lots of people grappling with the same types of questions, but on the other, there wasn't like a media outlet to actually talk about that, right? So there are a lot of resources for people to get into the SMB acquisition game, especially in America, buying like HVAC businesses, and then how do you get your SBA financing. But when you are an aggregator, like there's nowhere you can go to. You go to all these conferences, and they all tend to lionize and celebrate marketing people, engineering people. Nobody wants to celebrate the M&A people. So Pavel and I last May created Roll Up Europe, which has now become essentially the go-to resource for serial acquirers, primarily founders and operators, which teaches you, okay, like how do you build a holdco? Where do you raise the financing? What are the challenges you face? This morning we had an article about comp structures of Constellation Software. So we're doing this together with Pavel. We position this as the SaaSter of the holdco space. So we're working on conferences, we're working on various podcasts. The second thing I'm doing, as you said rightly, I'm building a holdco. So I'm actually sitting right now in Estonia, where my wife's from, working on a Baltic holdco of B2B services and niche manufacturing businesses. So very far from digital, but very good supply of businesses at the succession phase. And obviously, the fact that the region right now is experiencing a bit of a lull in investor sentiment for various reasons is also helpful. And the third thing I'm doing is just experimenting with a whole bunch of different things. I'm helping some budding aggregators raise capital. I'm helping a few businesses with the strategies, so really getting heavily engaged with the community.
I love that. Congrats. Firstly, again, why manufacturing businesses and more sort of like brick and mortar type businesses over ecom or SaaS for your roll up? Is it access to financing, or is it something else completely, or you just wanted fresh air?
Yeah. Well, it's not something that I just came up sitting on the sofa. This was actually the outcome of a 6-month search process. So, which resulted in short term a big disappointment to me, but I think in the medium term, it's actually gave me a lot more ideas. So I left Three Colts partly because I saw the power of focusing on a single ecosystem. And I was very convinced when I left that business last autumn that I'd be able to build my own platform play in no time. I was very cocky. I was very confident. I knew that there had to be something out there. So I looked at over 60 ecosystems, 60 app marketplaces, everything from Atlassian to Zendesk and in between, screened 180,000 apps. I started just making calls. So my initial idea was to exactly create a SaaS platform play like Three Colts, but in another ecosystem. And my learnings were twofold. I think one was there are a lot of businesses that are available out there where the people want to transact at very good multiples, but ultimately most of those businesses tends to fall into the high churn category. Website builders, e-commerce, a lot of CRM. And so you look at those businesses, you say, okay, churn's already very high. They are very vulnerable to artificial intelligence. They're very vulnerable to platform risk. And my experience from working for an e-commerce SaaS aggregator and also looking at other e-commerce SaaS aggregators was that you can buy those businesses. You can probably debt finance most of that. You don't need that much equity. But ultimately, raising institutional capital against a strategy like that, if you don't have a very strong industry angle, if you don't have a very strong platform play, it's going to be very difficult. I'm not going to make the same mistake again. So I kind of parked that idea. The second learning was that if you look at the more enterprise grade businesses, if you look at anything that's Salesforce related or ServiceNow related or Atlassian related, those underlying ecosystems are massive, right? There's thousands and thousands of apps. And most of those apps are very, very profitable. And most of those apps are still growing at 20 to 30% per year, like Atlassian itself. And so then I started going to conferences. I started talking to developers, and and for me, the main thing was to understand is distribution. I'm obsessed with distribution. I'm not really a product guy. I'm not really somebody who has a lot of engineering insight, but I'm very obsessed with if you have a product that's not that unique, how do you sell, right? So how can you explain that Atlassian alone has several dozen timesheets and they're all profitable? How can it be that you open up the Atlassian app marketplace, there's like 30 timesheets, each having between $2 and $20 million in revenues, they're all profitable? It makes no sense, okay? Well, it does actually, because when you look at the distribution structure, when you look at how those timesheets are distributed, you realize that they all have slightly different purpose, right? They all tend to be maybe more focused on like a geographic. So there's one guy who's selling timesheets into New Zealand companies, right? So there's somebody who works with railway companies across Europe. And that's when you realize that in those large enterprise app ecosystems, it's essentially friendship, albeit with a lot of tension between three main players. So the software vendor itself, let's say Atlassian. Then you've got your system integrators, so the companies that essentially implement and maintain Atlassian. And they also ultimately market those apps and ultimately have app developers. And sometimes system integrators own some apps, but it's very unlikely that the app developers become system integrators. So, and I think figuring out how do you distribute those apps, I understood that, listen, you can probably buy a nice Atlassian or Salesforce app business, and you can probably improve some of the outbound, but ultimately the biggest driver of growth is the relationships with the partners. If you can have enough of those elite partners to push through your app, you're going to be successful. But then I looked at that, I look at just how complex that game is. And I guess I just didn't have enough delusion that I'd be able to figure this out. So I pivoted a bit to work with the business. So I now work with the founders that are in those ecosystems that have insight into building specific roll-ups, but I myself focus on something that's a bit more defensible. But that's kind of one big learning, right? So 6 months, several hundred calls, lots of frustration, lots of people saying no, 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 several hundred pages worth of notes. And I think the second learning was that, listen, I work with a lot of private equity firms and family offices that are coming into Europe, specifically trying to buy vertical market software. So again, very different from Atlassian, very different from Salesforce, basically buying standalone solutions that target a very specific TAM. And I can tell you, the competition for those types of businesses right now is very intense. So if you don't have a very specific thesis, let's say you're trying to aggregate Spanish vertical market software in the ERP space or whatever it is, you're going to find it very difficult to originate deals. You're going to find it very difficult to be successful because unlike those newer ecosystems, the Salesforce and the Atlassians of the world, a lot of vertical market software businesses tend to be very old. We're talking about 20, 30 plus year old businesses. And so business owner is going to be a little bit older. And if you don't speak the local language, if you just send them an email, you're not going to get an answer.
Absolutely. Especially a business that's old as well. How quickly technology has changed, what it's built on.
That's it.
The development ongoing. There's just the compounding effect of difficulty. The difficulty only compounds, right? Yeah. Okay, cool. I love that. And so what's your goal with this roll up? Do you have a goal, or is it just you want to build this into a lifestyle business for you and your brother as well?
I think if I wanted a lifestyle business, I would have just stuck with Roll Up Europe, because then I can just publish blog, people by subscription. I don't think holdco is a lifestyle business. No, look, I'm a holdco enthusiast. I'm a big convert to value investing. It's almost like a religious moment that I had 3 years ago where I finally saw an industry where welcome, but I can also add something to it, right? You're buying cash flow businesses, you're buying real businesses, you're not betting on something that may or may not happen in a decade. So I want to live and breathe this ecosystem. Right now, for me, I'm from the Baltics, right? I was born in Lithuania. I grew up in Latvia. My wife's Estonian. I understand the cultural background in this region. I think there's a massive succession opportunity here, like in Germany. But unlike in Germany, it's just me right now, right? It's just me and my investors and my operators. So, and I want to enable that succession. I want to enable the next cohort of managers, of CEOs, to take over these businesses and to make them better. So that's my mission number one. My mission number two is grander in some ways, which is in Europe in particular, we've had misallocation of capital and misallocation of talent. I feel like too many people and too much pension money is going into venture, which is investing into dot companies. And too many people follow this kind of path where they do really well at university, get into private equity, or they get into venture, but they end up doing the same thing. They all end up chasing the same assets. And the problem in Europe is, growth is not returning anytime soon. So why not take all of these people? Why not take all this capital and relocate it to holdcos, SMEs, where there is going to be always growth, but those companies are just not efficient. So I want to relocate as much of that resource from unproductive to productive industries. And if my blog, if my initiatives help that, I'll be very happy.
I love that goal. Absolutely. Thank you so much for coming on, Alex, and having a chat and just sharing everything you've shared. You are definitely putting out some great work out there and really helping people and industries. And I appreciate it. And I'm sure everybody else does as well. Where can we send people to go find out more about you?
Listen, if you just go to Roll Up Europe, or if you just send me an email on alex@rollupeurope.com, or connect with me on Twitter or LinkedIn and just tell me what the idea is, if I can help you, or if you want to help me raise some money, let's connect. I always monitor my emails. I try to answer as much of those as possible. Just one thing I ask you not to do is just don't just wrongly criticize the content saying this is stupid, because I get some of that hate mail as well. And it's very difficult for me to respond to something that says you're wrong. If you tell me exactly what we're wrong, maybe we can create an interview like that or a joint article out of it. Let's just be a bit more constructive, because there are a lot of people come into the space, and I welcome discussion. I just don't like people who just tell me, oh, Alex and Pyle don't know what they're doing.
Yeah, that's a part of the game of being accountable in the world and putting your neck out there. Is there's definitely discrimination against your method, and just because Alex's method might not be for you doesn't mean you need to discriminate, and mine as well. So I'm definitely with you
Exactly.
on that, Alex. You can always move on, and to be honest, your energy, time, and attention shouldn't go into that. It should go into something that's a bit more constructive for you anyway. So
I
yeah, thank
agree.
you so much for coming on, Alex. Really appreciate the time.
Okay. Thank you, Jaryd.